Lehman Brothers, one of history's greatest bankruptcies. The dark story of America's fourth largest investment bank. September 2008. Panic. Beyond the glass doors in Midtown Manhattan stands a building that doesn't feel like it's dying. A tower rising 32 stories into the skyline. 10,000 employees, trillions in derivatives. Powerful. Yes, but that's just a facade. Behind these walls are toxic assets, mortgage-backed securities, leverage spiraling out of control. The losses mount like an avalanche. Then terror, the financial crisis, empty trading desks. To survive the catastrophe, employees must box their belongings while cameras roll. Humiliation instead of dignity. Bankruptcy instead of bailout. And there's more. Executive hubris, fatal miscalculations, and a price paid by millions who never worked on Wall Street. Can confidence make you invincible if it blinds you to destruction? And the real question, who actually destroyed Lehman Brothers? And how much did this collapse cost the world economy? If you enjoy deep investigations into corporate failures and the executives who led them, please subscribe, and tell me in the comments which bankrupt company to explore next. Your support makes these detailed stories possible. Thank you for being here. Let's begin. Monday morning, September 15th, 2008. Manhattan holds fear like a physical weight. The air tastes of panic and disbelief. Beyond Wall Street, past glass towers that seem invincible for over a century and a half, an institution refuses the word temporary. Lehman Brothers. It files for Chapter 11 bankruptcy protection, the largest such filing in United States history. Assets listed at $639 billion spread across global markets. Debts exceeding $613 billion. The gap between survival and extinction measured in billions that refuse to add up to salvation. Numbers signal magnitude, but they do not deliver the sensation. Stand on the 43rd floor trading room that morning and look around. Screens flash red across hundreds of terminals. Phones ring unanswered on desks already being cleared. Traders stare at positions worth nothing. Portfolios that evaporated overnight. The architecture is chaos, designed to announce that everything extraordinary has ended. Step past the executive suites, the mahogany panel conference rooms where billions were decided with handshakes, the private dining facilities where deals were sealed and the other face appears. Behind the prestige lies devastation. Deep in the risk management departments, spreadsheets show exposure that cannot be unwound. Trading books hold mortgage-backed securities no one will purchase at any price. Derivatives contracts, complex instruments woven through the global financial system like circulatory vessels, begin to rupture. Counterparties refuse to trade. Credit lines vanish. Liquidity, the lifeblood of any financial institution, stops flowing. The cost of keeping Lehman's collapse from spreading is impossible. Stock markets plunge worldwide. Credit freezes between banks uncertain who might fail next. Retirement accounts lose trillions in value. Businesses cannot access capital for payroll. Unemployment begins its climb toward double digits. The damage radiates from New York to London to Tokyo to every corner of the interconnected global economy. September 15th, 2008 is a catastrophe. Music dies in the trading rooms. Silence replaces the roar of commerce. Employees arrive to find security guards at entrances, boxes distributed for personal items, cameras filming their exits. For 158 years, the firm stood as a monument to American capitalism. For one morning, it becomes a monument to hubris and collapse. Under the chaos, a quiet pressure has been building for years. The firm was magnificent in its prime, and it was also a machine that consumed risk at a pace impossible to sustain. The profits were real. The danger was real. Together, they governed every choice that led to this moment. An unspoken question, present that morning and sharper with every investigation that follows, begins to form. How long could this have lasted? To understand what comes next, you have to understand who built this place and why. Let's go back to the beginning. The firm that collapsed in 2008 was not what you might expect. Lehman Brothers was born in 1850, founded by three brothers who arrived in America with nothing but determination and family bonds. Henry Lehman, the eldest, immigrated from Bavaria to Montgomery, Alabama in 1844. He opened a dry goods store. His younger brothers, Emmanuel and Mayer, followed in 1847 and 1850. Together, they transformed a modest shop into a commodity trading powerhouse. The American South in 1850 ran on cotton. Plantations produced it. Mills up north consumed it. Between production and consumption lay an opportunity. Merchants who could buy cotton from farmers, arrange transportation, and sell to textile manufacturers. The Lehman Brothers positioned themselves at this intersection. They accepted cotton as payment for dry goods, stored it, and sold it when prices rose. The business required judgment about crops, weather, prices, and creditworthiness. Risk was inherent. The brothers were careful. The Civil War disrupted everything. Cotton supplies collapsed as the Confederacy fell and plantations burned. The Lehman Brothers, who had built relationships and reputation across the South, faced ruin, but they adapted. They moved beyond cotton into general commodities. They began financing the transactions they had previously only brokered. Banking emerged as a natural extension of trade. In 1858, even before the war, the brothers opened an office in New York City, the nation's financial capital. Mayor Lehman took charge there. After the war, as the South slowly rebuilt and northern industry exploded, Lehman Brothers positioned itself to finance reconstruction and expansion. The firm underwrote bonds, raised capital for railroads, and facilitated the flow of money from investors to enterprises. By the early 20th century, Lehman had evolved into a full investment bank. The firm helped finance the emergence of American retail, underwriting securities for Sears, Woolworth, Gimbel's, and Macy's. It backed new industries as they appeared. Radio in the 1920s, petroleum, aviation. The Lehman approach was measured and relationship-driven. Partners knew their clients personally, understood their industries intimately, and took risks only after careful analysis. Crucially, Lehman Brothers was a partnership. Every partner had personal liability. If the firm failed, partners lost not just their investment, but potentially everything they owned. This structure enforced discipline. No partner wanted recklessness that could destroy them personally. Decisions were debated, risks were calculated, and leverage was limited. The firm grew steadily but carefully through the Great Depression, World War II, and the post-war boom. But partnerships have disadvantages. They limit capital to what partners can contribute. They make succession complicated. They restrict growth compared to publicly traded competitors who can raise billions by issuing stock. By the 1970s and 1980s, Wall Street was changing. Firms went public. Capital exploded. Trading volume soared. Investment banks transformed from relationship-driven partnerships into trading-focused corporations. Lehman Brothers followed this path in stages. In 1984, the firm merged with Shearson, a brokerage owned by American Express. The partnership dissolved. Lehman became a division of a large, publicly traded financial conglomerate. Personal liability vanished. Partners became employees. Compensation shifted from ownership stakes to salaries and bonuses tied to annual performance. The merger was rocky. Cultures clashed. Lehman's relationship bankers disdained Shearson's retail brokers. American Express executives micromanaged. By 1994, tensions reached a breaking point. American Express decided to spin off Lehman Brothers as an independent, publicly traded company. On May 31st, 1994, Lehman Brothers Holdings Incorporated began trading on the New York Stock Exchange. The newly public Lehman faced a changed landscape. Wall Street had become intensely competitive. Trading profits dwarfed traditional underwriting fees. Derivatives, complex financial instruments based on underlying assets, generated enormous revenues. Leverage, borrowing money to amplify returns, became standard practice. Firms that didn't grow aggressively lost market share, talent, and prestige. Leadership fell to Richard Fuld Jr., who became CEO in 1994. Fuld had joined Lehman's trading desk in 1969, worked his way up through fixed income, and survived the tumultuous merger years. He was known for intensity, loyalty to Lehman, and aggressive competitiveness. Colleagues called him the gorilla for his imposing presence and relentless drive. Fuld wanted Lehman to compete with Goldman Sachs and Morgan Stanley. the industry's elite. He pushed for growth in every division: equity trading, fixed income, investment banking, asset management. Under Full's leadership through the late 1990s and early 2000s, Lehman thrived. The firm expanded globally, opening offices across Europe, Asia, and the Middle East. Headcount climbed from roughly 8,000 in 1994 to over 28,000 by 2007. Revenues soared from $2.7 billion in 1994 to $59 billion in 2007. Stock price rose from $5 per share to peaks above $80. Lehman reported record profits year after year. Wall Street analysts praised the firm's transformation. Full appeared on magazine covers as a visionary leader. But the transformation had costs invisible in rising stock prices. The firm that traded cotton in 1850 based on tangible goods and personal relationships now traded mortgage-backed securities based on mathematical models and borrowed money. The firm that limited risk in 1900 because partners faced personal liability now magnified risk in 2000 because executives were compensated with stock options that rewarded short-term gains. The culture that prized caution gave way to a culture that demanded growth, and growth, pursued without limits, builds fragility. Lehman Brothers in 2007 looked magnificent. Lehman Brothers in 2007 was also brittle, one shock away from fracture. The shock was coming. It was already forming in the American housing market, in mortgages extended to borrowers who couldn't repay, in securities built on assumptions that couldn't hold, in leverage that amplified profits during booms and magnified losses during busts. The question nobody asked loudly enough was simple: how long can this last? To understand what comes next, you have to understand the machine Lehman built and how it broke. The machine was built on real estate. By the early 2000s, America was experiencing a housing boom unlike anything in its history. Home prices rose year after year. Mortgages were easy to obtain. Lenders competed aggressively, lowering standards to capture market share. People who previously couldn't qualify for loans suddenly received approval. Subprime mortgages, loans to borrowers with poor credit histories, proliferated. Adjustable rate mortgages with low teaser rates that would reset higher became common. Stated income loans, where borrowers simply declared their earnings without verification, earned the nickname liar loans. Wall Street saw opportunity. Investment banks developed methods to bundle mortgages into securities and sell them to investors worldwide. The process worked like this. Mortgage lenders would originate loans to home buyers. Investment banks would purchase those mortgages, pool them together, and create mortgage-backed securities, MBS. These securities were then sliced into tranches, layers with different levels of risk and return. Rating agencies like Moody's and Standard & Poor's would evaluate the tranches and assign ratings, often AAA for the safest layers. Investors, from pension funds to foreign banks to insurance companies, would buy these securities, seeking higher yields than government bonds offered. The model appeared brilliant. Homeowners got mortgages. Lenders earned fees. Investment banks earned fees for packaging and selling securities. Investors earned returns. Risk seemed distributed across thousands of mortgages and hundreds of investors. Even as some borrowers defaulted, the theory held that diversification would contain losses. Housing prices would keep rising, allowing struggling borrowers to refinance or sell. The system felt like perpetual motion, generating wealth for everyone involved. Lehman Brothers jumped into this market aggressively. The firm had historically focused on corporate finance and trading, but under Full's growth mandate, Lehman expanded into mortgage origination, securitization, and proprietary trading of real estate assets. In 1997, Lehman acquired several mortgage lenders. In 2003, it purchased BNC Mortgage and Aurora Loan Services, both subprime specialists. These acquisitions gave Lehman direct access to mortgage origination, the raw material for securitization. The strategy was vertical integration. Lehman would originate mortgages through its lending subsidiaries, package them into securities through its investment banking division, sell some securities to investors while keeping others on its own books, and trade mortgage-backed securities actively to profit from price movements. Every step generated fees or trading profits. The potential returns were enormous. Lehman's real estate exposure grew rapidly and deliberately. By 2007, the firm held approximately $85 billion in mortgage-related assets, including whole loans, mortgage-backed securities, and commercial real estate. Much of this was financed not with Lehman's own capital, but with borrowed money. The firm's leverage ratio, the amount of borrowed money for every dollar of equity, climbed above 30 to 1. Some internal measures suggested leverage reached 44 to 1 when off-balance sheet items were included. Leverage is an amplifier. When assets rise in value, leverage magnifies gains. If you borrow $30 for every $1 of your own money and invest in assets that gain 10%, your return is 300% on your equity. But leverage cuts both ways. If those same assets decline 3%, your equity is wiped out entirely. At 30 to 1 leverage, a small decline in asset values means insolvency. Lehman's leadership understood leverage intellectually, but appeared to believe their risk management systems and market expertise would protect them. The firm employed hundreds of risk managers, used sophisticated computer models to estimate potential losses, and maintained diversified portfolios. Fuld and his executive team, particularly Chief Financial Officer Chris O'Mara and later Aaron Callan, projected confidence publicly. Quarterly earnings calls emphasized Lehman's strong position, disciplined risk management, and bright prospects. Inside the firm, some voices expressed concern. Risk officers questioned the size of real estate positions. Some traders worried about asset quality in mortgage pools. A few executives suggested reducing leverage and exposure. These concerns were raised in meetings, documented in emails, and occasionally escalated, but they were not heeded. The revenue from real estate was too substantial. Compensation was tied to profitability. Competitors like Bear Stearns, Merrill Lynch, and Citigroup were making billions in mortgages. Fuld feared Lehman would fall behind if it retreated while others advanced. This is a familiar dynamic in finance. During booms, caution feels like cowardice. Warnings sound like pessimism. The executives and traders generating profits gain influence and credibility. Those urging restraint seem out of touch. Institutional culture reinforces optimism because optimism is profitable, until suddenly it isn't. By 2006, warning signs were visible to anyone willing to look. Housing prices plateaued in several major markets, then began declining. Inventory of unsold homes climbed. Mortgage defaults started rising, first slowly, then accelerating. Subprime borrowers with adjustable rate mortgages faced payment resets they couldn't afford. Foreclosures increased. Securities backed by subprime mortgages lost value as defaults exceeded models' predictions. Lehman's response reveals a psychology of denial. Rather than reducing exposure, the firm initially increased it. In early 2007, even as cracks appeared, Lehman acquired mortgage assets at what seemed like attractive prices from distressed sellers. The logic was opportunistic. Competitors were panicking. Lehman could buy low and profit when markets recovered. Fuld believed the downturn was temporary, a correction that would create opportunities for firms with capital and discipline. But the downturn was not temporary. It was the beginning of a collapse. By summer 2007, the subprime mortgage market was in free fall. Securities that had been rated AAA were downgraded to junk. Hedge funds that specialized in mortgage investments failed. Banks that held mortgage-backed securities began reporting losses. Credit markets tightened as lenders became wary of any institution with real estate exposure. Lehman reported its first quarterly loss in 14 years in the second quarter of 2008, $2.8 billion. The firm wrote down the value of mortgage assets, sold what it could at steep discounts, and attempted to raise capital by issuing new stock and selling stakes to investors. These efforts produced mixed results. Some investors stepped forward. Others examined Lehman's books and walked away quietly, unwilling to catch a falling knife. By summer 2008, Lehman faced a crisis of confidence. The firm's stock price, which had traded above $80 in early 2007, fell below $20, then $10, then $5. Credit default swaps, insurance contract against Lehman's bankruptcy, spiked in price, signaling that markets believed failure was increasingly likely. Counterparties, the banks and institutions that traded with Lehman, demanded more collateral for transactions. Some refused to trade with Lehman at all, accelerating the liquidity crisis. Lehman was experiencing a classic bank run, not customers lining up to withdraw deposits as in Great Depression, but institutional counterparties refusing to lend and demanding immediate repayment of overnight loans. For a firm operating at 30-to-1 leverage, dependent on continuous short-term borrowing to fund long-term assets, this was fatal. Without liquidity, Lehman could not meet obligations. Without meeting obligations, Lehman could not function. Without functioning, Lehman would collapse. Full believed rescue was coming. Lehman was too important, too interconnected, too large to be allowed to fail. The term too big to fail had become common after Bear Stearns collapsed in March 2008 and was rescued by J.P. Morgan Chase with government backing. Fuld assumed Lehman would receive similar treatment. He was tragically wrong. The Federal Reserve and Treasury Department, led by Chairman Ben Bernanke and Secretary Henry Paulson respectively, had different calculations. Bear Stearns had created panic. Rescuing Lehman would create moral hazard, the expectation that reckless firms would always be saved, encouraging future recklessness. Political pressure was intense. Lawmakers and the public were angry about bailouts. Paulson, himself a former Goldman Sachs CEO, faced accusations of favoring Wall Street over taxpayers. The decision was made: no public money for Lehman. The firm had to save itself or find a private buyer. The final weekend, September 13 to 14, 2008, was a desperate scramble. Wall Street CEOs gathered at the Federal Reserve Bank of New York, summoned by regulators to find a private solution. Two potential buyers emerged: Bank of America and Barclays, a major British bank. Negotiations ran through Friday night, all day Saturday, and into Sunday. Bank of America examined Lehman's books and recoiled. The firm's mortgage positions were worse than advertised. Valuation was uncertain. Losses could be staggering. Bank of America executives concluded that Merrill Lynch, another firm teetering toward failure, was a cleaner acquisition. On Sunday morning, Bank of America announced would buy Merrill Lynch instead, leaving Lehman without an American suitor. Barclays remained. The British bank negotiated intensively with Lehman executives and U.S. regulators. A deal seemed possible. Barclays would acquire Lehman's core businesses, stabilize operations, and absorb losses with government guarantees for Lehman's trading obligations during transition. The problem was regulatory approval. Barclays required clearance from UK financial authorities. British regulators, watching the chaos unfold, refused to approve a deal that could threaten UK financial stability. Without guarantees and without British approval, Barclays withdrew late Sunday night. Lehman Brothers had run out of time, options, and hope. The firm's board met in emergency session. The numbers were stark. Cash on hand was insufficient to open for business Monday. Credit lines were closed. No buyer existed. No government rescue was coming. The only choice was bankruptcy. At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers Holdings Incorporated filed for Chapter 11 bankruptcy protection in U.S. Bankruptcy Court for the Southern District of New York. The filing listed $639 billion in assets, making it the largest bankruptcy in American history, surpassing WorldCom and Enron. The petition listed debts of $613 billion owed to thousands of creditors worldwide. The announcement hit global markets like a shockwave. What had been feared was now real. Lehman Brothers, a 158-year-old institution, had collapsed, and nobody knew what would fall next. Monday morning, September 15th, brought chaos beyond the bankruptcy filing. Lehman Brothers was not simply a firm. It was a node in the global financial network, connected by thousands of contracts, trades, and relationships to every major bank, hedge fund, pension fund, and corporation. Its failure sent tremors through a system built on trust and continuous transactions. Stock markets opened and immediately plunged. The Dow Jones Industrial Average fell 504 points, the largest drop since the September 11th, 2001 terrorist attacks. European and Asian markets had already fallen sharply overnight as Lehman's collapse became clear. Banking stocks were hit hardest as investors fled anything connected to finance. Fear was indiscriminate. Credit markets. The machinery through which corporations and financial institutions borrow short-term froze. Banks stopped lending to each other, uncertain which institutions might have hidden Lehman exposure. The overnight lending rate, normally stable and predictable, spiked. Commercial paper markets, where companies borrow for payroll and operations, seized up. Businesses that had nothing to do with mortgages or Wall Street suddenly couldn't access capital. Lehman employees arrived at offices worldwide to find security guards and instructions. Headquarters at 745 7th Avenue became a media circus. Television cameras filmed workers carrying cardboard boxes of personal belongings. Some cried. Some shouted angrily at reporters. Many walked in stunned silence. Careers built over decades ended in hours. Stock options worth millions on paper were now worthless. Retirement accounts evaporated. Roughly 25,000 Lehman employees worldwide faced unemployment in an economy sliding toward recession. The human cost extended beyond Lehman's walls. Counterparties who had traded with Lehman faced immediate losses. Derivatives contracts, many designed to run for years, were suddenly in limbo. Who owed what to whom when one party no longer existed? Hedge funds that used Lehman for prime brokerage, the service of holding and financing securities, couldn't access their positions. Assets were frozen in bankruptcy proceedings. Some funds failed as a result, creating additional cascading failures. Perhaps most terrifying was the revelation of interconnection. Lehman had been party to approximately 900,000 derivative contracts with a notional value exceeding $35 trillion. Notional value is not the same as actual money at risk. It's the reference amount for calculating payments, but the complexity was staggering. Unwinding these contracts would take years of litigation and negotiation. In the meantime, uncertainty paralyzed markets. The day after Lehman's bankruptcy, AIG, the massive insurance conglomerate, teetered toward collapse. AIG had sold credit default swaps, essentially insurance against bond defaults, to institutions worldwide. With Lehman's failure and mortgage securities plummeting, AIG faced collateral calls it couldn't meet. On September 16th, the Federal Reserve and Treasury reversed course from their Lehman decision and orchestrated an $85 billion rescue of AIG, later expanded to $182 billion. The reversal was jarring. Lehman failed. AIG was saved. The distinction seemed arbitrary, driven by panic rather than principle. Money market mutual funds, considered among the safest investments available to ordinary investors, broke the buck. The Reserve Primary Fund, which held Lehman debt, saw the value of its shares fall below $1, triggering mass redemptions. Investors pulled $140 billion from money market funds in one day. The Treasury Department was forced to guarantee money market funds to stop the run. Within a week of Lehman's bankruptcy, the global financial system was in free fall. Credit markets remained frozen. Stock markets gyrated wildly. Banks hoarded cash. Governments worldwide intervened with emergency measures, capital injections, guarantees, interest rate cuts. The panic was existential. People wondered if the financial system itself might collapse entirely. On September 19th, Treasury Secretary Paulson and Fed Chairman Bernanke appeared before congressional leaders to request $700 billion for a program to purchase troubled assets from banks, what became the Troubled Asset Relief Program, TARP. Bernanke reportedly told lawmakers that without immediate action, we may not have an economy on Monday. Congress initially rejected the request. Markets plunged further. Congress reversed and passed TARP on October 3rd. Lehman's bankruptcy became the symbolic center of the financial crisis. Other failures contributed. Bear Stearns, AIG, Washington Mutual, Wachovia, the collapse of Iceland's banking system, sovereign debt crises in Europe. But Lehman's failure was a moment when crisis became catastrophe, when fear became panic, when the abstract concept of systemic risk became concrete and terrifying. The question everyone asked was why. Why did regulators let Lehman fail? Why didn't someone save it? Why did a single firm's collapse nearly destroy the global economy? The answers were complex, debated, and unsatisfying. Lehman had made reckless choices, but so had competitors who were rescued. Regulators wanted to impose discipline. But the cost of that discipline was trillions in lost wealth and millions of lost jobs. The financial system was interconnected, but nobody had fully mapped those connections or understood the cascade that would follow. The aftermath was brutal and prolonged. The Great Recession officially lasted from December 2007 to June 2009, but its effects persisted for years. U.S. unemployment peaked at 10% in October 2009, the highest rate in over a quarter century. Roughly 8.7 million jobs were lost. GDP contracted sharply. Housing prices fell 30% nationally, more in markets like Las Vegas, Phoenix, and Miami. Foreclosures exceeded 3.8 million in 2010 alone. Retirement accounts lost trillions in value, delaying retirement for millions. Globally, the crisis spread like contagion. European banks with exposure to U.S. mortgages faced losses. Iceland's entire banking system collapsed, requiring an international bailout. Greece, Ireland, Portugal, and Spain faced sovereign debt crises as recession shrank tax revenues. Unemployment in Spain exceeded 25%. Social unrest followed. The political consequences included the rise of populist movements, skepticism toward institutions, and lasting anger at financial elites. Lehman Brothers had not caused all of this. The seeds were planted over years: excessive leverage across the industry, regulatory failure to supervise systemic risk, credit rating agencies that stamped approval on toxic securities, borrowers who took on debt they couldn't repay, lenders who extended that debt without due diligence, and a culture that celebrated short-term profit over long-term stability. Lehman was part of a system that failed collectively, but Lehman's collapse was the trigger. It transformed a serious financial crisis into an existential one. It revealed that no institution was safe, that rescue was not guaranteed, and that the consequences of failure were too severe to accept. Lehman Brothers became a cautionary tale, a symbol of hubris, excess, and catastrophic misjudgment. And at the center stood decisions. Decisions to pursue growth at any cost. Decisions to leverage beyond reason. Decisions to ignore warnings. Decisions to believe that housing prices could only rise, that models could predict the future, and that rescue would always arrive. Every one of those decisions was made by people who believed they were doing their jobs, serving shareholders and building value. Every one of those decisions contributed to disaster. The search for accountability began before the rubble settled. Congressional hearings started in September 2008 and continued for months. The House Committee on Oversight and Government Reform summoned Lehman executives, particularly CEO Richard Fuld, to testify. On October 6, 2008, Fuld sat before the committee and faced questioning that was less inquiry than indictment. Representative Henry Waxman confronted Fuld with internal Lehman documents, showing that Fuld had received approximately $480 million in compensation, salary, bonuses, and stock sales between 2000 and 2008. Waxman's implication was clear. Fuld had enriched himself while leading the firm toward destruction. Fuld defended himself, stating that much of his compensation was in stock now worthless, and that he lost enormous personal wealth in the bankruptcy. He expressed regret for Lehman's failure, but not personal culpability. He blamed the financial crisis, market conditions, and what he characterized as irrational panic. Other Lehman executives testified similarly. They acknowledged a failure, but attributed it to unprecedented market conditions rather than managerial errors. They pointed out that Lehman's competitors had made similar bets on real estate, and that many were rescued, while Lehman was not. The implicit argument was, our decisions were reasonable given the information available. We were unlucky, not reckless, and the government's decision not to rescue us was the proximate cause of disaster. Public reaction was fury. Americans watching their retirement accounts collapse and their neighbors lose homes saw executives who had earned millions deflecting responsibility. The hearings were theater, providing no real consequences but allowing public anger a forum. Fuld became the face of Wall Street excess, vilified in editorials, political speeches, and popular culture. Criminal investigations followed. The FBI, SEC, and Justice Department examined whether Lehman executives had committed fraud, misleading investors about the firm's financial condition. Prosecutors focused particularly on accounting practices. Internal investigators discovered that Lehman had used Repo 105 transactions to temporarily move assets off its balance sheet, before quarterly reports, making leverage appear lower than it actually was. Repo 105 transactions worked like this. Lehman would sell assets to another party with an agreement to repurchase them shortly after the reporting date. Because the sale was structured such that Lehman received slightly more than 105% of the asset's value, accounting rules allowed it to be treated as a sale rather than a loan. This removed the assets from Lehman's balance sheet for the quarterly report, temporarily reducing reported leverage. After the report, Lehman would buy the assets back. The practice was not illegal per se, but it was misleading. It created a false impression of Lehman's leverage and financial health at critical reporting dates. The bankruptcy examiner Anton Volukis concluded in a 2,200-page report that Repo 105 transactions were used to move $50 billion off the balance sheet at the end of first quarter of 2008 alone. Volukis found that senior executives, including Fuld and CFO Aaron Callan, knew about Repo 105 but failed to disclose it adequately to investors and regulators. Despite these findings, no senior Lehman executive faced criminal charges. Prosecutors concluded that while Repo 105 was deceptive, it did not meet the legal standard for criminal fraud. Proving fraud requires demonstrating intent to deceive and material misrepresentation. Lehman's lawyers had vetted Repo 105. Accounting rules, however questionable, permitted it. The executives could claim they believed the transactions were legal. Bad judgment, even catastrophically bad judgment, is not a crime. The decision not to prosecute infuriated the public and many legal scholars. The perception was that Wall Street executives had destroyed the economy and faced no consequences beyond lost bonuses and damaged reputations. Some argued that prosecutors, facing well-funded legal defenses and complex financial details difficult for juries to understand, chose not to pursue cases they might lose. Others suggested regulatory capture, a system where financial elites were insulated from accountability. Civil penalties were limited and largely symbolic. The SEC charged Lehman Brothers Holdings Incorporated with fraud related to Repo 105, but since the firm had dissolved in bankruptcy, there was no entity to penalize beyond reputation. The SEC reached settlements with several former executives, including Fuld, who paid relatively small fines without admitting wrongdoing. Fuld settled for $10 million, a fraction of his estimated wealth. Shareholders filed class action lawsuits seeking to recover losses. These suits dragged through courts for years. Some resulted in settlements paid from insurance policies and from banks that had underwritten Lehman securities. Total recoveries for shareholders were pennies on the dollar compared to losses. Bondholders and creditors fared slightly better, recovering perhaps 20 to 30 cents per dollar owed through the lengthy bankruptcy process. The bankruptcy itself was historic in scale and complexity. Lehman Brothers Holdings Incorporated and its hundreds of subsidiaries worldwide required untangling. Some divisions were sold quickly. Barclays purchased Lehman's North American investment banking and capital markets divisions, along with its headquarters building, for approximately $1.75 billion. Nomura Holdings bought Lehman's operations in Europe and the Middle East for $2 billion, and its Asian operations for $225 million. These sales provided some employment continuity for Lehman staff in those divisions, but returned relatively little to creditors given the firm's massive debts. Other assets liquidated slowly. Real estate holdings, equity positions, derivatives contracts, all had to be valued and sold or settled. The process took over a decade. As late as 2016, the bankruptcy estate was still making distributions to creditors. Final recovery rates varied by creditor class, but unsecured creditors received approximately 35 to 40 cents per dollar owed, far less than the value they had expected when the claims originated. Regulatory response came in the form of the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in July 2010. The legislation ran over 800 pages and aimed to address the causes and consequences of the financial crisis. Key provisions included the Volcker Rule, restricting banks' proprietary trading, higher capital requirements for large institutions, creation of the Consumer Financial Protection Bureau, enhanced oversight of derivatives, and establishment of the Financial Stability Oversight Council to monitor systemic risk. Dodd-Frank also created the Orderly Liquidation Authority, a mechanism to wind down failing financial institutions without the chaos of bankruptcy or taxpayer bailouts. The goal was to avoid future too-big-to-fail crises by giving regulators tools to dismantle failing firms systematically. Whether these tools would work in an actual crisis remains untested and debated. The law faced immediate opposition from the financial industry. Banks lobbied to weaken provisions. Implementation required hundreds of specific regulations written by agencies, a process that dragged for years and became a battleground. Some requirements were delayed. Others were diluted. By the mid-2010s, there were efforts to roll back Dodd-Frank, particularly for mid-sized banks. The debate over whether the reforms were effective or excessive continues. Culturally, Wall Street initially sobered. Bonus pools shrank. Leverage ratios fell as banks raised capital and reduced risky assets. Risk management departments gained authority. Compensation structures were modified to include clawbacks if profits later reversed. Recruiting narratives shifted from celebrating aggression to emphasizing prudence. But cultural change proved ephemeral. By the mid-2010s, as memories faded and markets recovered, compensation climbed again. Trading profits returned. Some banks argued that excessive regulation was hampering economic growth and stifling innovation. A new generation of employees entered finance without direct experience of the crisis. The lessons seemed to be fading. Some argued this was inevitable. Finance attracts competitive people. Competitive people push boundaries. Pushing boundaries generates innovation and risk. Without continuous vigilance, the cycle repeats. Others argued the fundamental problem remained unsolved. Institutions too large and interconnected to fail create moral hazard, incentivizing risk-taking with the implicit assumption of rescue. The debate is not academic. It shapes policy, regulation, and the possibility of future crises. Lehman Brothers is a test case, the moment when too big to fail was tested and failed, when consequences were allowed to unfold, when the cost of failure was revealed to be catastrophic. Whether that lesson prevents future crises or simply ensures that next time rescue arrives more quickly remains an open question. Lehman Brothers itself exists now only as memory and case study. The name survives in legal documents, bankruptcy filings, and academic papers. Business schools teach Lehman's collapse as a cautionary tale in risk management, corporate governance, and crisis decision-making. Finance professionals cite it as the moment when assumptions about liquidity, leverage, and government support were shattered. The building at 745 7th Avenue, Lehman's headquarters, bears a different name now. Barclays occupied it after acquiring Lehman's North American operations, adding its own signage. The trading floors where trillions once changed hands daily have been reconfigured. The executive suites where Fuld and his team made billion-dollar decisions are offices for different executives making different decisions. The thousands who worked at Lehman scattered across the industry and beyond. Some landed quickly at competitors, their skills valued despite the taint of Lehman's collapse. Others struggled, finding that Lehman on a resume carried stigma. Some left finance entirely, moving into consulting, technology, academia, or entrepreneurship. A few wrote memoirs, attempting to make sense of what happened and their role in it. For Lehman's former employees, the collapse was personally devastating in ways that transcended lost income. Many had devoted careers to the firm, worked brutal hours, sacrificed personal relationships, and identified closely with Lehman's success. The bankruptcy felt like betrayal. Some blamed Fuld and senior executives for recklessness and arrogance. Others blamed regulators for not rescuing Lehman, as they had rescued others. Still others blamed the system itself, a culture that rewarded short-term profits and punished those who questioned the prevailing optimism. The personal costs extended to families. Employees who had accumulated wealth in Lehman stock saw it vanish. Stock options that had seemed like guaranteed retirement turned worthless overnight. Some faced foreclosure on homes purchased at the market's peak with mortgages they could no longer afford. Marriages strained under financial and emotional stress. Children saw parents consumed by anger, depression, or denial. Beyond Lehman's employees, millions felt the ripple effects. Homeowners who lost houses to foreclosure. Workers laid off as the recession deepened. Retirees who saw decades of savings shrink. Small business owners who couldn't access credit. Students who graduated into the worst job market in generations. The damage was diffuse but real, touching nearly every sector and geography. The macroeconomic costs defy precise calculation, but were staggering. The International Monetary Fund estimated global financial losses from the crisis at approximately $2 trillion. But that captures only direct losses on securities and loans. The broader cost, measured as lost economic output, is far larger. GDP in the United States and Europe grew far more slowly after 2008 than pre-crisis trends would have predicted. Cumulative lost output over a decade likely exceeded $10 trillion in the U.S. alone. Globally, estimates run to $25 to $50 trillion when accounting for foregone growth, unemployment, and reduced investment. Beyond economics, the crisis had political and social consequences. Trust in institutions, already declining, plummeted. Occupy Wall Street emerged in 2011, channeling anger at financial elites and inequality. Populist movements gained strength across democracies, often fueled by resentment toward bailouts that saved banks while ordinary people suffered. Brexit, the rise of nationalist parties in Europe, and political polarization in the United States all trace roots partly to the financial crisis and its aftermath. The perception that executives faced no consequences, while workers bore the cost, fueled cynicism about fairness and justice. When Richard Fuld could settle civil charges for $10 million after earning hundreds of millions, when no senior executive went to prison, when banks returned to profitability and bonuses while unemployment remained elevated, the social contract felt broken. The idea that success and failure both carried consequences, that markets were fair, that the system rewarded prudence and punished recklessness, these beliefs were damaged, perhaps irreparably for many. Lehman's collapse also revealed the inadequacy of existing regulatory structures. Regulators had failed to see systemic risk building. They had relied on banks' internal risk models. They had allowed leverage to climb to dangerous levels. They had not mapped the interconnections that made one firm's failure catastrophic. After 2008, regulatory philosophy shifted toward macroprudential oversight, looking at the system as a whole rather than individual institutions in isolation. But implementing this philosophy proved difficult. Data was incomplete. Models were uncertain. Political will wavered. The financial system that emerged from the crisis was different but not transformed. Banks were larger, not smaller. The top institutions grew through acquisitions of failing competitors. J.P. Morgan Chase absorbed Bear Stearns and Washington Mutual. Bank of America bought Merrill Lynch and Countrywide. Wells Fargo acquired Wachovia. The result was greater concentration, the opposite of what breaking up too big to fail institutions would require. Capital levels increased. Leverage ratios fell. Stress testing became routine. Banks held more liquid assets. These changes made the system more resilient, but they did not eliminate risk. They shifted it. Shadow banking, financial activities outside traditional regulated banks, grew. Private equity, hedge funds, and non-bank lenders expanded into spaces banks vacated. Whether this dispersion of risk made the system safer or simply made the next crisis harder to detect remains debated. Technological change accelerated after the crisis. High-frequency trading, algorithmic strategies, and electronic markets increasingly dominated. Finance became faster, more complex, and more dependent on technology. These changes brought efficiency and reduced certain costs. They also created new risks. Flash crashes, operational failures, cybersecurity threats. The next crisis might not resemble 2008. It might emerge from technology, geopolitics, climate change, or some combination of shocks. What remains constant is the fundamental tension at the heart of finance. Financial institutions perform essential functions, allocating capital, managing risk, facilitating transactions. But they also generate fragility. Leverage amplifies returns and risks. Interconnection enables efficiency and creates contagion. Short-term funding supports long-term investment, but creates vulnerability to runs. These are not bugs. They are features of how modern finance operates. Lehman Brothers was both unique and emblematic. Unique in its specific choices, leadership, and timing. Emblematic of broader dynamics. The culture of Wall Street in the 2000s, the housing bubble, regulatory capture, the belief that sophisticated models and market discipline would prevent disaster. Lehman's collapse was the firm's failure, but it revealed an industry's fragility and a system's vulnerabilities. The question for policymakers, regulators, and citizens is whether enough has changed to prevent the next Lehman. The reforms are real but incomplete. The culture has shifted but not transformed. The incentives are modified but not realigned. Human nature remains. Ambitious people in competitive environments will push boundaries, take risks, and occasionally make catastrophic errors. What history teaches is that crises recur. They take different forms. They emerge from different sectors. But they share common elements: excessive optimism, underestimated risk, high leverage, interconnection, and the belief that this time is different. Until those elements are addressed systemically, not just in regulation but in culture and incentives, the potential for another crisis remains. Lehman Brothers stands as a monument to what happens when those elements converge. The firm lasted 158 years. It survived wars, depressions, and technological revolutions. It did not survive its own choices in the early 21st century. That should be warning enough. Who paid for Lehman Brothers? Everyone. Employees who lost careers and savings, shareholders who held worthless stock, creditors who recovered pennies on the dollar, taxpayers who funded bailouts of other institutions, homeowners who lost houses to foreclosure, workers who lost jobs in the recession, retirees whose portfolios collapsed, students who graduated into depression, small businesses that couldn't get loans, families whose lives were upended by economic chaos, countries whose economies contracted, the global system that lost trillions in wealth and decades in growth. The cost was not just financial. It was social, political, and psychological. Trust in institutions declined. Faith in markets was shaken. The social contract felt broken. Inequality widened as asset prices recovered faster than wages. The political consequences included populism, polarization, and cynicism that persist today. How much did Lehman's failure cost? The International Monetary Fund estimated $2 trillion in direct financial losses globally. Lost economic output over a decade likely exceeded $10 trillion in the United States alone, potentially $25 to $50 trillion globally. Over 8 million jobs were lost in the U.S. during the recession. Roughly 3.8 million foreclosures occurred in 2010. These are numbers. Behind them are people, lives disrupted, plans destroyed, futures altered. But the deeper cost is harder to measure. It's the lost confidence that markets are rational, the lost belief that success comes from prudence rather than risk-taking, the lost faith that institutions will protect the vulnerable, the lost assumption that consequences follow actions fairly. These intangible losses shape behavior, politics, and society in ways that ripple forward indefinitely. The story of Lehman Brothers is ultimately a story of confidence misplaced and consequences deferred until the furrow was no longer possible. For years, decades even, the firm made choices that accumulated risk invisibly. Leverage climbed. Real estate exposure grew. Warning signs were dismissed. Models were trusted. Rescue was assumed. And then, in a span of months, weeks really, the accumulated fragility revealed itself. The firm that had seemed impregnable collapsed into bankruptcy. The system that had seemed stable lurched toward meltdown. It is also a story of adaptation's absence. Biltmore survived because its stewards adapted when circumstances changed. They sold land, opened doors, changed the estate's purpose while protecting its core. Lehman collapsed because its leadership could not or would not adapt. When housing markets turned, they doubled down. When liquidity vanished, they expected rescue. When the end came, they had no plan beyond hope. The question for any institution is whether it can change when the world changes. Markets shift. Conditions evolve. Assumptions that held for years suddenly fail. Institutions that survive are those whose leadership recognizes change early, acts decisively, and accept that adaptation, however painful, is preferable to extinction. Lehman Brothers answered that question with rigidity disguised as confidence. The firm believed its own narrative. It assumed housing prices could only rise, that leverage was genius, that models predicted the future, that Lehman was too important to fail. Every one of those beliefs proved false. And because leadership could not abandon those beliefs, could not adapt when evidence contradicted assumptions, the firm died. This is a central lesson, more important than regulatory minutiae or technical financial details. Institutions fail when they cannot adapt. Leaders fail when they cannot change. Crises occur when systems become brittle. Lehman Brothers became brittle through leverage, concentration, and cultural rigidity. When pressure came, it shattered. The tragedy is that the pressure was foreseeable. Housing bubbles had occurred before. Leverage had caused failures before. Interconnection had created contagion before. History provided warnings. But warnings require someone willing to listen, to question, to act against short-term incentives. At Lehman, that willingness did not exist at the level and moment needed. In the end, Lehman Brothers collapsed because confidence replaced caution, leverage replaced equity, models replaced judgment, and short-term gains replaced long-term thinking. These are not unique to Lehman. They are endemic to finance when culture, regulation, and incentives do not counterbalance them. Until that balance is achieved and maintained, the next Lehman is not impossible. It is probable. The question is not if, but when, and whether the next time we will have learned enough to prevent catastrophe, or at least contain it. Lehman Brothers suggests the answer is uncertain at best. The firm's collapse cost trillions and touched millions. The reforms that followed were real, but incomplete. The culture has shifted, but not transformed. The fundamental dynamics remain. That is why Lehman Brothers matters beyond its own story. It is a warning that has not been fully heeded. It is a lesson that has not been fully learned. It is a chapter in a larger story of financial fragility that continues to unfold. The house of cards that was Lehman Brothers fell on September 15, 2008. The question we must ask ourselves is whether the house we have rebuilt is made of stronger materials or simply stacked more carefully, waiting for the next tremor to reveal its true strength. If you enjoy deep investigations into corporate collapses and the executives who led them, please like this video and subscribe to the channel. Your support makes these detailed stories possible. Tell me in the comments which bankrupt company should we explore next. Enron and its web of accounting fraud that fooled Wall Street for years, Blockbuster Video's refusal to adapt to streaming, and its stunning fall from 9,000 stores to zero, Toys, R Us, and how private equity debt crushed a beloved brand, Pan Am's transformation from aviation pioneer to bankrupt failure, Sears' century-long decline from America's largest retailer to a shadow, or perhaps something unexpected, a forgotten corporation whose collapse changed an industry and destroyed lives. These companies aren't just failures. They're warnings written in bankruptcy filings and shattered careers, built by real people, destroyed by real decisions, preserved in case studies so we might recognize the patterns before they repeat. Every empire has its rise and fall. Every boom contains the seeds of its bust. Every confident executive believes this time is different until they learn it never is. Lehman Brothers lasted 158 years and died in 158 days. That ratio should terrify anyone who believes stability is permanent. Thank you for watching. I'll see you in the next investigation.